Hello guys, and welcome to MarketsGator, a channel dedicated to retail investors. Here, we are discussing different trading and investment strategies which retail investor can utilize. We are also checking the news, discussing developments, markets, and trends. Today's topic is Benjamin Graham's formula to calculate stock's fair value. Questions we are going to answer today are how to calculate fair stock value using Graham's famous formula, see how it works, calculate the values for several stocks manually, move from theory to practice. I will try to create simple trading strategy using this formula, backtesting, and see how the strategy would perform through the years. Take a critical look. What are the weak points of Graham's approach? Draw a conclusion. Does it really work in the real world? So, fasten your belts. It will be an exciting. The formula we're talking about today comes from Benjamin Graham's legendary book, The Intelligent Investor. This is how it looks like. Let's look what each letter and component stands for. V, it's fair stock value, the one we actually want to find. EPS, it's company's earnings per share. This parameter can be easily extracted from company's financial statement. 8.5, this is a constant value, and according to Graham, it's price to earnings ratio of non-growth stocks. G, it's a projected growth rate in percents. According to Graham, we should look for long-term growth estimates from 5 to 7 years or longer. 4.4, another constant, which is an average yield of high-quality corporate bonds. And finally, Y, it's a current yield of corporate bonds. Now, let's get our hands dirty. Let's take several stocks and we'll calculate their fair value. The stocks I choose are Apple, Ford, AT&T, and Tesla. But I strongly encourage you to do this exercise yourself. Take the stocks you like, or maybe the ones you're having in your portfolio right now, and do the calculations. To get the data we need, let's open Yahoo Finance website. It's a really great resource, my go-to when I need to do a quick analysis and when I need financial data to pull. Here where you can find the info we need. For Apple, EPS is here, and the growth rate we'll take from analysis page. Let's taking next year value, which is 7.993. Let's assume that stock will be growing with this rate going forward. And hers is the information for Ford. We are taking EPS from summary page and growth rate from analysis. Then we'll do the same for other stocks and plug values into our formula. To get AAA bonds yield, we'll go to St. Louis Fed's website and we'll find the page Moody's Seasoned AR Corporate Bond Yield. Here we see that most recent bond yield for AAA bonds is equal to 5.35. Let's take this value. What I like about this resource is that we can also download the historical data. So we're taking the CSV file with almost 100 years of bond yields info I'll use on the next step when I'll be backtesting strategies. This table contains the parameters I took, including the stock prices, so we can compare them to the fair value calculated. Let's start with Apple. According to formula, its value is $132.23, but current stock price is $226.79. To measure how fair value relates to current price, let's divide price by value, and we'll have a ratio. For Apple, the ratio stands to 1.72, meaning price is 72% higher than its fair value. Doing the same exercise for the Ford stock. Now we see that while the price is $11.42, but the fair value, according to Graham's formula, is $32.16. And price to value ratio is 0.36. To us, it means that current price reflects only 36% of fair stock value. Next is AT&T stock. Its price to value ratio is 0.84, meaning that 84% of company's fair value is reflected in the price. Now let's look at Tesla. And we see that while stock price is $347.79, fair value is only $120.47. Price to value ratio is 2.75, showing us that price is whopping 175% higher than actual stock value. Having these numbers, what conclusions can we make? Let's set the thresholds. What we are accounting for stock fairly valued, which stocks we'll consider overvalued, and which will be treated undervalued. Let's assume that if price is within plus minus 20% range near fair value, the stock is fairly valued. For us, it means price to value ratio between 0.8 and 1.2. If price to value ratio is higher than 1.2, the stock considered overvalued. And if the ratio is below 0.8, let's treat the stock as undervalued. We can go even more granular to have definitions for highly overvalued and undervalued stocks, but let's keep it simple for now. Having that in mind, we can say that Apple stock is overvalued. Its price is 72% higher than its fair value. Ford, very undervalued stock, only 36% of its fair value is reflected in current market's price. AT&T, since it's within the range of plus minus 20%, we can say that it's fairly valued. And Tesla, according to Graham's formula, it is very overvalued stock since price is 175% higher than it should be. Now, as we manually tested the approach, let's now try to utilize it and try to get something tangible out of it. Using the steps discussed previously, let's create a simple investment strategy which will identify undervalued stocks and we'll be adding them to the portfolio. At the same time, if a stock in our portfolio is overvalued, we're closing the position and replacing it with stock from the list of undervalued ones. Assumptions are: 1. I'll be selecting stocks from top 500 by market capitalization. 2. I'll keep PE for non-growth stocks equal to 8.5% for now, as it mentioned in the original Formula 3. AAA bonds average yield, instead of Graham's 4.4, I'll be using average value calculated from Fred's data, 4. And G, it's 1 year estimated EPS growth provided. Here is my strategy. At start, calculate fair value of all stocks from Universe 500 top market cap stocks. Calculation ratios, price to fair value for each stock. Select N most undervalued stocks ratio below inclusion threshold. I'll start with 0.7. Then, every M days, for example, every 1 month or 1 quarter, recalculate fair value and price to value ratios. Exclude from portfolios stocks where ratio above are overvalued exclusion threshold. Let's start with 1.1. Replace excluded positions with new undervalued stocks. For example, if 3 positions are dropped, we'll need to find another 3 stocks which ratios show that they are undervalued and add them. To backtest my strategy, I'll be using an online platform called QuantConnect. This is my workhorse for testing my investment ideas. If you have any programming skills, I strongly encourage you to try it. Here, I'm opening my account and opening the project which I created. To control how strategy is behaving, I added several parameters. Start and end date. This is our testing range of time. As you can see, I decided to start from January 2021 and up till now, which is more than 4.5 years. Initial deposit. How much money we start with? Let's set 1 million. Our benchmark is SPY, S&P 500, ETF. We'll be comparing our strategy to buy and hold strategy of this fund. Rebalance frequency. How often we're checking for overvalued and undervalued stocks. Stocks count. How many positions I'll be holding in my portfolio. Let's start with 10. Here it is, unchanged. PE no growth. This is Graham's 8.5 constant. Average yield on AAA bonds, 5.69. Size of our universe, 500 stocks. Inclusion threshold, value of price to value ratio, when we treat stock as undervalued, setting to 0.7. And exclusion threshold, when ratio is above 1.1, stock treated as overvalued. I've also introduced a special parameter for minimum price to value ratios to exclude anomalies when due to reporting issues value is too high. Let's start with results for our baseline strategy, 10 stocks, holding period 30 days. As you can see, it produced some positive results. Total return is 70.6%, cumulative annual return is 12%, and drop down 34.8%. Not bad. Now let's try to play with the parameters. I'd like to see what is the strategy's sensitivity to them. Since Graham was focused on long-term investments, maybe we need to rebalance less frequently. Let's change rebalance frequency to 90 days. The results show us that this didn't really help much. Net profit is 67.1%, 3% lower than baseline strategy. Annual return, 11.56%, also lower. And drop down is almost the same, 34.5%. Next, let's try to return to 10 days rebalancing period, but increase number of stocks in portfolio from 10 to 20. Hypothesis is, maybe our portfolio is too concentrated. Let's allocate smaller portions of our funds for each stock initially. Running the strategy with updated parameters, and we're getting these results. Net profit, 51.37%. Compounding annual return, 9.24%. Both numbers are worse than previous. The only improvement is drawdown. It's 29.6% now. And let's make one more test. Keeping 20 stocks, but increasing rebalance period to 90 days. After running the strategy, we see no magic, with same drawdown, but annual return 8.83% and net profit of 48.74%. It's the worst case scenario. For your convenience, here in this table, I collected the stats for these 4 runs. And what about Benchmark, our SPY fund? For the given period, it demonstrated following results. Total return, 83%. Annual return, 13.5%. And drawdown, only 24%. So far, our strategy can't beat the market. Let's run another round of experiments. In this round, I want to utilize the fact that not all stocks are created equal. It is commonly known that EPS, growth rate, and other factors varies from industry to industry. In this round of tests, I want to add one more dimension to the strategy, sector. What I'll do now is I'll be taking the stocks only from either healthcare, technology, utilities, and so on. There are 11 sectors available. Let's find out. Maybe our strategy will perform better for stocks from some sectors than the others. For this, I've added one more parameter to my strategy, sector. With its help, I'll be passing sector name to the strategy. Now let's do the runs for each sector and check the outcomes. And here we are. This table shows the results of each run, one per sector. Please note the sectors communication, services, and energy. When running the strategy for these sectors, it appeared that default inclusion and exclusion thresholds 0.7 and 1.1 are not applicable to them. No undervalued stocks were found. In order to run a strategy, I had to increase the thresholds to 0.9 and 1.3, respectively. There are only 2 sectors where this strategy fares pretty well. It's consumer cyclical and technology. There it beats the market in terms of annual returns, around 16% each. But the drawdown is also bigger than markets, 31.6 and 35.5% respectively. On the other side of the spectrum, we have consumer defensive stock. Their strategy is actually losing money. Now, let's return to our strategy and do some retrospective. What can be changed in our parameters to get better results? First, we can increase our universe. Let's not limit ourselves to first 500 stocks. Maybe if our universe will be broader, we'll find more cases of undervalued stocks which are flying below the radars of regular investors. Second, PE for non-growth stocks constant. Graham calculated it several decades ago, but since then, lots has changed. It makes sense to calculate a new value and do another round of tests. Or maybe this value should be different for each sector. Third, values for our inclusion for exclusion thresholds. It's worth playing with this range and find the best one for each sector. Another possible modification? We can try to change our approach to rebalance. For example, let's rebalance after some constant period of time, but as soon as any stock becomes overvalued, let's replace it with undervalued immediately. It will be interesting to check how it will fare. As you can see, even with simple strategy like this, there is still plenty room for improvements. My advice to you, try it yourself, play with it, and if you have any ideas, feel free to share in comments to this video. At the end, let's summarize what we learned. Good thing about this strategy is its simplicity. I'm a big fan of simple solutions because there are more chances that they will fare well as time passes, and more chances the approach will be applicable when the markets change. Another good thing is the focus on quality stocks, earnings, and growth. It's clear and intuitive. Also, the simplicity allowed us to implement a fairly simple strategy which generated positive results, and in some sectors, even beat the market. It will be interesting to run these tests over a much bigger time frame, for example, for a period of 10 or 15 years, and see how it behaves during different market cycles, interest rate regimes, inflation, and so on. On the other hand, it is clear that this valuation approach alone can't be used in isolation. It must be a part of broader framework. That's what the Graham's book is about, actually. I also don't like that it relies on magical constants. Markets change, and we should have an approach to adopt with them. Also, even though I like simplicity, this approach is too simple and doesn't account for differences between the industries. Overall, I'd use the Graham's valuation method as a good starting point. It is a good foundation to build your investment strategy on. And this is it for today. If you like this video and would like to see more breakdowns and analysis like this, click like and subscribe. Thank you, and see you again.